Hey there, future Wall Street wizards. Ever heard of vanilla options? Don't worry, we're not talking about dessert toppings here. In the exciting world of finance, vanilla options are the most basic type of options contract. They're like your training wheels before you hop on the bicycle of more complex financial instruments. A vanilla option gives you the right, but not the obligation, to buy or sell an underlying asset at a specific price, called the strike price, on or before a certain date, the expiration date. Think of it like reserving a concert ticket. You have the option to buy it at a fixed price, but you can always choose to skip the concert if you change your mind. They're the foundation upon which a whole world of options trading strategies is built. Now let's talk about making that money. You see, buying options is like betting on a horse race. You're hoping the price of the underlying asset goes in your favor. But selling options? That's like being the casino. You're collecting premiums. Think of them as small fees from buyers who are hoping for a big win. When you sell an option, you're essentially acting as an insurance provider for the buyer. If the market moves in their favor, they'll exercise their option, and you'll have to fulfill your end of the bargain. But if the market doesn't cooperate, you get to keep their premium as profit. Now, let's zero in on one specific option strategy that's perfect for generating passive income selling puts. This strategy is often favored by seasoned traders and investors looking to generate consistent returns with a relatively lower risk profile. When you sell a put option, you're giving the buyer the right to sell you 100 shares of an underlying asset at a specific price, known as the strike price, on or before a certain date, referred to as the expiration date. This means you are essentially agreeing to buy the asset if the buyer decides to exercise their option. In return for this right, the buyer pays you a premium. This premium is yours to keep, no matter what happens with the underlying asset's price. If the price of the underlying asset stays above the strike price, the buyer won't exercise their option, and you get to keep the premium as pure profit. This scenario is ideal because you earn money without having to purchase the stock. You just made money without even owning the stock. This is one of the key attractions of selling puts, the ability to generate income without a significant initial investment. However, if the price of the underlying asset falls below the strike price, the buyer might exercise their option, forcing you to buy 100 shares of the underlying asset at the strike price. This could be seen as a downside, but it's important to remember that you entered this agreement with a clear understanding of the risks involved. But hey, you still have the premium you collected to offset any potential losses. This premium acts as a financial cushion, reducing the overall impact of the price drop. And if you believe in the long-term prospects of the underlying asset, this might even be a good opportunity to buy shares at a discount. By acquiring the shares at a lower price, you position yourself to benefit from future appreciation, turning a potential risk into a strategic advantage. All right, ready to start selling puts like a pro. The first step is to choose the underlying asset you want to trade. This could be a currency or even a commodity, but for this strategy, it is better to operate only on currencies. The key is to pick something you understand and believe in. Remember, selling puts is like being a landlord. You're essentially renting out the right to sell you an asset. So, you want to choose an asset that you wouldn't mind owning if the market takes a downturn. We operate with currencies because if they were to be assigned, not having a physical underlying, we would not be forced to buy the shares. The goal here is to find solid assets that you're comfortable holding for the long term. Section 5. Step 2. Selecting the right strike price. Once you've chosen your underlying asset, it's time to pick the right strike price for your put option. This decision is crucial as it can significantly impact your potential returns and risks. The strike price is the price at which you're willing to buy the asset if the buyer decides to exercise their option. Now here's the trade-off. A higher strike price means a higher premium. If you sell a put option with a higher strike price, you'll receive a larger premium upfront. This can be attractive if you're looking for immediate income. We are relatively relaxed because, as I was saying, we cannot be assigned, but our goal is to make a profit and stay away from risks. On the other hand, a lower strike price means a lower premium. Conversely, if you sell a put option with a lower strike price, you'll receive a smaller premium upfront. This might be less appealing if you're seeking higher immediate returns, but it's also less likely that the price will come against you, as the market has to fall further for the option to be in the money. This can be a safer bet if you are cautious about market volatility. The key is to find a strike price that aligns with your individual risk tolerance and investment goals. Consider your financial situation. market outlook, and how much risk you're willing to take on. Section 6, Step 3, Determining the expiration date. The next step is to choose an expiration date for your put option. This is the date on or before which the buyer can exercise their option. Expiration dates can range from a few days to several months in the future. And just like with strike prices, there's a trade-off to consider. Shorter expiration date means higher time decay. Options with shorter expiration dates have higher time decay, meaning their value erodes more quickly as the expiration date approaches. This can work in your favor as a put seller, as you're essentially collecting a larger portion of the premium upfront. Longer expiration date means lower time decay. Options with longer expiration dates have lower time decay, so their value erodes more slowly. Section 7. Step 4. Placing your put option trade. You've chosen your underlying asset, selected your strike price, and determined your expiration date. Now it's time to place your put option trade. Open your brokerage account and navigate to the options trading platform. Enter the ticker symbol of your chosen underlying asset. Select Sell Put, and choose the appropriate strike price and expiration date. The platform will automatically calculate the premium you'll receive for selling the option. Once you've reviewed everything and are ready to proceed, click Confirm to place your trade. Congratulations, you're officially a put option seller. Section 8. Managing your risk strategies for success. In this section, we will explore some essential strategies that can help you navigate the complex world of investments and trading. Selling put options can be a great way to generate passive income, but it's important to remember that all investments come with risks. Understanding these risks and knowing how to manage them is crucial for long-term success. Here are a few strategies to help you manage your risk and increase your chances of success. These strategies are designed to provide a balanced approach to trading and investing. Start small. Don't bet the farm on your first few trades. Begin with smaller investments to get a feel for the market and understand how it operates. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different assets to minimize risk and maximize potential returns. Use stop-loss orders. Consider using stop-loss orders to automatically limit your losses if the market moves against you. This can help protect your capital and prevent significant losses. Roll your options. If the market moves against you and your put option is in danger of being assigned, you can consider rolling your option to a later expiration date or a different strike price. This strategy can provide flexibility and additional time for the market to recover. This can give you more time for the market to recover or reduce your potential losses. By implementing these strategies, you can better manage your risk and increase your chances of achieving long-term success in the financial markets. Section 9. Real-life examples. Selling puts in action. Let's bring this all together with a real-life example. Say you're bullish on euro-dollar and believe its currency price will continue to rise in the long term. You could sell a put option with a strike price slightly below the current market price and an expiration date a few weeks out. If euro-dollar price stays above the strike price, your option will expire worthless, and you'll get to keep the premium as profit. But currency price falls below the strike price. You might be assigned the shares. However, since you're bullish on euro-dollar, you wouldn't mind owning the shares at a discount. Another example, you believe the euro-dollar will remain relatively stable in the coming months. Section 10. Benefits and pitfalls. Weighing the pros and cons. Like any investment strategy, selling puts has its benefits and potential pitfalls. Let's take a closer look. Benefits. Potential for passive income. Selling puts allows you to generate premium income without having to actively trade stocks. Flexibility and control. You get to choose the underlying asset, strike price, and expiration date, giving you greater control over your risk and potential reward. Potential to acquire assets at a discount. If your put option is assigned, you get to buy the underlying asset at a price below the market price. Potential pitfalls. Limited profit potential. Your profit potential is capped at the premium you receive when you sell the put option. Section 11. Conclusion. Your journey to options mastery. Congratulations, you've made it to the end of our crash course on selling puts for passive income. You've learned the basics of vanilla options, discovered the power of selling puts, and explored the step-by-step process of placing and managing your trades. Remember, options trading can be a powerful tool for generating income and achieving your financial goals. But it's crucial to approach it with caution. do your research, and manage your risk effectively. Now go forth, my fellow investors, and unlock the potential of passive income with the art of selling puts. Disclaimer: the information provided in this video is for educational and informational purposes only and should not be construed as financial advice. The content is based on the author's personal opinion and experience and is not intended to provide specific financial, investment, tax, legal, or any other advice. You should conduct your own research and consult with a licensed financial advisor, accountant, or other professional before making any investment decisions. The author and publisher of this video are not responsible for any financial loss, liability, or risk incurred as a result of your investment activities. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. The strategies discussed in this video may not be suitable for all investors. By viewing this video, you agree to the terms of this disclaimer and acknowledge that any investment decisions you make are your own responsibility. If you enjoyed this video, make sure to hit that like button and share it with your friends. And don't forget to subscribe to our channel for more amazing content. When you subscribe, be sure to click the bell icon so you get notified every time we post a new video. Your support means the world to us and helps us keep creating the content you love. Thanks for watching, and see you in the next video.